Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields, getting ever so closer to 3%. This has been the talk since late 2017. Some were even talking about it before that. And all through 2018, it was sort of this hype that we were going to get to 3%. And then all of a sudden you were going to see this massive shift and treasuries were going to sell off because the Fed was unwinding their balance sheet and supply was going to go up. How are we going to pay for these infrastructure? And things didn't really go that way. We kind of traded in a range. We got to 295. We pulled way back to 270. Now we've seen 10-year Treasury yields rally 30 basis points. We got just a hair from 3%, which I think right now is significant because if we do see any kind of buyers come in, this is going to be their level. They're going to wait, and if Treasuries get north of 305, they're probably going to get out. But I think some are using this as a vault level. Which way is it going to go? Are we going to go towards 3.25 or back towards 270? And I think right now it's very uncertain. But given the fact that the trend has been seen Treasury yields, moving higher over the last week or so, I think it's safe to say that you're going to see a lot of positioning and such that you're waiting for that move. Wait and see if we can get a settlement in a sustained period north of 3% before you come in and start selling again. And I think that 3% in itself, because we haven't been here in 5 years, is probably an attractive buy. So you got two opposing forces there. We'll have to wait and see what happens. Likewise, it's going to have a lot to do with the Fed and the data and whatnot. And if you look at market volatility, it's starting to rise again. Not to the level I think that when you say, boy, we haven't had Treasury yields this high in 4+ years. And really since the last time they were this high, we were talking about the taper tantrum and how the Fed was going to unwind its balance sheet and stock prices were 30% lower. I would think there'd be more urgency, but we haven't seen that yet. So right now, Treasury volatility remains, it's higher, but it's just not giving you any signals that there's any fear in the market. So yields are up, volatility's kind of mixed. And I think the big key part of this week, the data that we've been talking about, and pretty much we'll talk about every quarter or so, is GDP. We're going to get advanced first quarter GDP. Expectations have been all over the map. If you look at the GDP Now numbers, last came in around 2%. We're going to get a look just before the number comes out on Friday. And I think that right now 2.2 is sort of the consensus. But anything below 2% is going to be very curious how the market reacts, because we've seen treasuries sell off. Will you see that reverse very quickly? Likewise, we've seen equities sell off. We've seen gold sell off. Will that all reverse with the fact that maybe if growth isn't there, the Fed can't act as aggressively as they want to? So right now, all eyes are going to be on earnings in the equity markets, the commodity prices that we've seen fluctuate so much based on tariffs and trade wars and whatnot. And Treasury yields, though, are going to steal the show come end of the week if we are still hovering at 3% and that GDP number is looming, because that is going to be the catalyst whether we see a move towards 3.25 or back towards 270. So right now, Treasuries nearing that 3% level we haven't seen in so long, but could it be a big move coming on Friday? GDP will tell us. This is Todd Colvin coming to you from the floor of the CME Group.